Before we start the podcast, I just wanted to say a quick thank you to our sponsor, Money Farm. Now, Money Farm are the leading online wealth manager in Europe, also known as a robo-advisor. Now, Money Farm have managed to combine extremely low charges while outperforming their peers. Now, you could read a full review of Money Farm on moneytothemasses.com. Just search for Money Farm review. But not only that, podcast listeners can take advantage of a special offer where Money Farm will manage the first £20,000 of their investment for free for a year if they enter the code MTTM20K when they sign up at moneyfarm.com.
Hello and welcome to episode 156 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leakes. Damien, we got there in the end. How are you doing?
Yeah, we got there in the end. Andy did about 4 takes to start this podcast. No, I'm good. Very good this week, Andy. Been busy as ever. Yourself?
Yeah, really good. I've been keeping abreast of the financial news this week because it's been a fairly big week, which I'm sure you're going to cover in the podcast coming up. What have you been up to this week outside of the pod? Never mind about me. I want to hear about you.
Well, not too much actually, Andy, but my most exciting thing this week, if you follow me on social media, you would have seen images of some new cushions for the office. Now, I'm not just talking any old cushions. I'm talking branded Money to the Masses cushions. So if you haven't seen them, go on to, it's a big wow, there's 2 of them. Go on to Facebook and Instagram, and I shared images of them. They were actually made by a local mum, in fact. So one of my children, my oldest goes to school down the road, and one of the mums down there puts images onto any sorts of goods you like, particularly T-shirts and stuff like that. And I asked her if she could do cushions for our office, and they look amazing. So go and have a look on Facebook.
They do look amazing. Why I did that wry laugh there is because she's a friend of a friend. You kind of have to say that anyway. But they do look fantastic. Do go online and have a look. In fact, I'm thinking of getting some branded cushions myself.
What, Money to the Masses cushions, or are you going to get some?
Well, not Money to the Masses ones as such. When I say branded, I meant sort of personalised. Photos and stuff to wind certain family members up.
Yeah, they're very good. I mean, I know there are other people out there that do it, but it's always nice to support a local business, and especially someone who is trying to build a business while they have children at school and at home. And as I know what it's like to try and juggle all these things like lots of parents. So it was quite good to do it. So that was a highlight for me to finally get those and sit on them. So there we go. while I watch the budget.
Yeah. Talking of cushions, do you like cushions? My wife constantly has a go at me because we've got about, I don't know, too many, about 6 cushions on our sofa. And before I sit down, I have to move them all out of the way and bury my back in. I can't deal with cushions. I don't know.
I'll nip this one, Andy. I don't like cushions either. So I just like branded ones. I just needed one in the sofa we've got in the office isn't very comfortable. That's the upshot of it. So I don't mind them. I don't like to be lost amongst cushions. I don't like too many of those. I just like enough just to firm up against your back, which I normally pull at the gym.
Damien, what have we got on the podcast this week?
As I was sitting on my cushions, I was watching the budget. Now, the budget happened earlier this week, and I'm going to go through that, what the pullouts and the things you should pay attention to. Leading on from that, I'm going to treat people to 2 investment pieces this week. We had a bit of a respite a couple of weeks ago, but there is a piece off the back of the budget, so funds that you might want to invest in that can benefit from the budget. It's a very topical piece, and one that you sometimes see. I'm often asked by journalists about that sort of thing. The other one is an investment piece that's loosely based around some things I've been doing for 80/20 Investor, my DIY investment service, and it's to do with investing trends, and I just want to talk broadly upon them or about them and what people should do to sort of identify them and a little bit more around them. Really, it will become clearer when I do that piece. So shall we start with the budget? We might as well go straight in, mightn't we, on the budget?
I think we should, yeah.
I mean, I'll make a confession straight away on the budget. When it normally starts about 12:30, I don't know if anybody out there knows that, and most people are probably sensible enough to not watch it and let people like me watch it and then relay what happens. But I went to the gym, and by the time I came back, it was just after 1 o'clock and nothing had happened so far in the budget. They were still meandering through the forecast, and it just shows you over about an hour it was about an hour and 10 minutes it lasted. And to sum up, in this budget, not a lot happened. It was one of those, it was a budget that Philip Hammond had pretty much tried to make sure he didn't make any mistakes. That was it. That was what he was trying to do. I don't know if you remember the last budget we had, he made a number of changes that he had to perform a spectacular and embarrassing U-turns on. One of them was to do with national insurance for self-employed people. And so to avoid those embarrassments, because don't forget the government is struggling of late with lots of embarrassing episodes with different ministers. So it was a case of he was just trying to get through unscathed. So the big things on big picture stuff, in terms of economic growth, it's not particularly a bright picture. What they've finally admitted that growth forecasts have been downgraded for each of the next few years to levels that have not been seen for pretty much decades. So that is largely the fault of Brexit, or the potential Brexit when it comes, and as a result the government's going to have to borrow more. So that is just the economic stuff out of the way. So what about us personally? The real positive is there was no news is good news, is really when it comes to this budget, because there were no major changes to personal taxation. So that's a big hooray for most people out there. So that means there was no change to the dividend tax allowance. That's still at £5,000, which will be music to the ears of investors and people who pay themselves via dividends. There was also no changes to the VAT levels, because they were going to be, there was speculation at one point that they may reduce the threshold at which people have to be VAT registered. That didn't happen, so another bonus. Pensions is normally another area where, do you know what, Andy? I think I've lost count of how many budgets I've followed and autumn statements, and therefore how many, which is all of them, where there's been speculation that pension tax relief or some changes to pensions would happen, and inevitably nothing did. There's been odd ones where we've had some stuff in the past, like George Osborne's notorious pension freedoms, but this one we got through completely unscathed. There was no changes to pension legislation.
And was that a surprise?
I mean, I think it was a surprise that in conjunction with the taxation there was nothing that happened. I think that by the end of it, people were, I think, pleasantly surprised. If you work in the industry, you're certainly pleasantly surprised, because it means you don't have to change things for clients or rewrite half the stuff you've already written. I think journalists were probably sitting there thinking all that copy that they'd written in preparation for hours, that they couldn't then go, oh, right, we didn't actually make a version for nothing happened.
They just bookmark that in the Outlook calendar for early next year and hope it springs up then.
Yeah, so from that perspective, I think people were pleasantly surprised, because I think we need a break from tweaks to pension legislation, because I think one of the problems is that people don't trust pensions and they feel that if they invest in them, the rules could change. And but I think another thing, what happened, people were really looking for the potential change to stamp duty. You remember last week I did a kind of predictions of what could be in the budget, and I mentioned about there could be a change to stamp duty, and now there was. And very simply, the change that came about is they abolished stamp duty for first-time buyers buying a house worth less than $300,000. In a nod towards higher prices in areas like London, they actually allowed, if the house you're buying is worth less than $500,000, then the first $300,000 of that price wouldn't be liable to stamp duty. So they were trying to give some impressive numbers, saying it could save people as much as £5,000 in stamp duty, and it was really an aim to try and kickstart the housing market. Whether it does that, I'm not sure, because I actually saw some numbers to suggest that only about 3,500 people would even benefit from that. So it was a measure that was meant to be exciting, get people within the industry excited. There were measures that were linked to house builders, trying to promote new houses being built, trying to encourage people who have houses that are empty to get rid of them. They actually allowed local councils to pretty much double the council tax being charged on those places. So for most people, there was nothing really in the budget bar this stamp duty thing. So
did you just say that potentially only 3,500 people would actually benefit from that change? That's a crazy low number.
Well, that was one of the early estimates that I've seen. Whether that's been upgraded. I very much doubt. If it has, then great. But the amount of money that relief would provide, and the amount of money we needed to provide that, essentially that relief, did mean it was almost disproportionate, the effect it would have. So yeah, I mean, if you were a first-time buyer last week and you bought a house, then you're going to be pretty upset because you just paid a load of stamp duty, which is non-existent from as of the day of the budget occurred. So now, if you bought a house today, you wouldn't be paying that stamp duty. Of course, I forgot to mention the rail cards. We talked about it last week. They had what's been dubbed the millennial rail card, but of course it doesn't. There's always a caveat. So it actually only off-peak it relates to. So you're getting this discounted rail fare is off-peak and you're under 30. So it's no good if you're commuting to work, but it might be okay if you're going to visit your mum or friends or family or something like that. So it's one of those things that sometimes looks good on paper. In terms of people might want to know tax allowances, I know they can look them up, but just broadly, all the tax allowances were nudged up by a few £100, which is in line with what we would expect. So our income tax personal allowance is now $11,850 from April next year. The amount you can earn before you would become a 40% taxpayer will rise to $46,350. And the CGT allowance has gone up by £400 to $11,700. So there was nothing really more exciting than that. There were other minor tweaks to do with things like the tax for certain diesel cars, but they're really old diesel cars. There was a tweak to do with EISs, which are enterprise investment schemes, which are a form of investing that is tax incentivized to help. Basically, cut a long story short, rich people trying to avoid tax can legally invest a lot of money into these schemes whereby they help up-and-coming companies, and typically things like tech companies, and they get a 30% tax relief. Well, that's pretty juicy, and it used to be you could put $1 million in a year. Now it's going to go up to $2 million. The upshot is you can get 600 grand's worth of tax relief, which is hideous. So again, that impacts hardly anyone, which is why I'm sort of skirting over it. But the rich out there who probably vote Tories will, I'm not being political, it's just a fact, they will benefit. So they were the main things on the budget. Like I said, there was nothing that was too exciting or anything that was going to cause too much uproar. I think people are trying to find in the small print at the back of the budget something to get excited about, but really there was not a lot in there. And the other positive was small businesses were left alone for once. Normally they seem to always have a pop at small businesses, which I never understand, and they were left alone too. So there you go, the budget roundup. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insight, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers in the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service, let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
And it was almost as if it was planned, Damien, just coming out of that wonderful advert, hearing your dulcet tones talking about what is a fantastic service, the 80/20 Investor service. You're going to tell us about investment trends, which links in quite nicely with the 80/20 service.
Yeah, I mean, what I want to talk about is it's really a bit of insight on how you analyse things and to get people interested in when they're investing and understanding how their portfolio might work. And this week I was doing something for 80/20 Investors, a research piece, about global funds. And one of the things that people might not realise is that there are lots of different sectors with funds, and they're grouped together, and one of them is called global. And the idea, you probably think that they're invested very globally in different stock markets. The reality is that they are quasi-US funds. So by that I mean they predominantly invest in US equities, and some of that is down to the way they pick their allocations in almost in proportion to the market cap of the world. So the US stock market is one of the biggest stock markets, obviously, so therefore has a higher weighting. But they also do it because, I'm talking about the fund managers here, they also do it because they have plenty of research and historical data on American companies. There's not so much on companies from emerging markets. So we're talking about things in China, or even places that will be even far smaller and less transparent economies. So that's why there's always a skew towards them. And now, what came out of it, the member asked me to do some research into picking a fund or funds that weren't so skewed. And so the first thing I want people to note is that when they're picking global funds, generally speaking, you're taking a bet on the US stock market. And some of them have as much as 60% invested in the US stock market. So with the US stock market being very high and people going, oh, I don't want to be in the US equities, I'm going to probably go a bit more diversified. If you do it with a global fund, which is what your IFA will do, he's actually not diversifying all that much. And typically, if he does, well, the rest of the fund is normally invested in Europe and the UK. That's hardly diversified, and very little is in the areas of the market that have actually done very well this year, which is emerging markets. So the point of the piece which I went on to do for them was showing them how to find one of these funds and identifying some for them. But in doing so, I ended up looking at a lot of data to do with performance of different funds over a period of time. And one of the things I always do is try and ask myself why when you're looking at performance tables. And it's just something I want to, which is the real message of this piece, is when you look at a performance table of funds, so you maybe have 100 funds in it, and you might look at what the period is. You might look at it and you'll see lots of different names. Then almost you have to sort of take a step back and not obsess about individual funds as such, but look at general trends that appear in there. Now, by that, try and explain why a fund or a group of funds at the bottom may have only returned, say, 2 or 3% in a year, while the ones at the top have all returned maybe as much as 16, 17%. Now, that isn't down to just pure skill by the manager. In fact, lots of investing isn't much skill in it. It's sometimes just about being in the right place. And so by doing that, you can then start to pick out 1 or 2 funds at the top and 1 or 2 funds at the bottom, and just almost looking at them side by side and going a bit sort of bleary-eyed and seeing what the difference is. And in doing so, then if you did that in the global world, global funds, you will notice that the reason if you're at the top of the pile in terms of performance this year, it was just because you had the biggest US exposure. If you're at the bottom, it was down to the fact you had probably the lowest US equity exposure. And that doesn't necessarily mean the fund at the bottom is bad. It just means that manager is taking a deliberate, diversified approach. So what I'm really telling people is there's a reason why things can happen. Sometimes it is just because the fund is rubbish and the manager has just had some bad picks and the companies invested in are terrible. But sometimes it's just an underlying trend that the table reflects, a big macro trend. And that's really interesting to pull out, because then you can see, well, do you know what? If I want to take a bet that I don't really want to be in US equities, then you know that picking one towards the bottom isn't going to be necessarily a bad idea, if that makes sense, Andy. So
yeah, you're just making that sort of, you're coming to that conclusion and making that punt. You're not necessarily picking a dud. You're just picking that trend and going with it. I get it.
Yeah, and it's really, even if you don't act upon it, the point is you start to notice things and you start having that inquisitive mind about things. And if you have an inquiring mind, that is the biggest thing I would ever want to try and instill in people when they do 80-20 investor or otherwise about money, is to get them just to ponder why. It doesn't matter if there's any outcome, it's just sort of, I wonder why that is. And as soon as you get people start to become inquisitive, they'll go off and the whole world will open up where they start thinking, well, that was interesting. Equally, another example is if you look at Japanese funds right now, you might sit there and go, well, why is that Japan fund over the last 2 or 3 months just returned about 10%. That's enormous amounts. And most of the others down here have only done a few percent. Why is that? And if you start to then look at the fund, and this gives you another example that's true today, part of the reason is because some Japanese equity funds actually hedge out the currency exposure. We talked probably quite a long time ago about hedging on this podcast, but quite simply, if you buy an asset in a foreign country, not only have you got the you make or lose money on the fact that the price of that asset will go up and down in that local currency, but then when that's converted back into pounds, you've got that currency exchange rate can move. And of course, you can hedge that out, so you only are therefore exposed to the asset going up and down in that local market's prices. So you can hedge that out, so you are only exposed to the price moves in that market, so denominated in that currency. So, for example, in the Japanese equity market, there are a few funds that try and hedge out a lot of exposure to the pound, which means that recently the yen plummeted. And as a result, this is against the dollar, and as a result, there's always this sort of relationship. The Japanese stock market went through the roof, because if the yen falls, it means that the exporters in Japan are more competitive, and their stock market is very driven a lot by a lot of exporters in it. So it's similar to the sort of pound FTSE relationship we've talked about in the past over here. The yen and the topics or the Nikkei over in Japan has a similar relationship. So the problem is that if you have that currency, if you have the pound in there as well, muddying the waters, what you make on the stock market in Japan, you could lose on the currency exchange going back the other way. So the point is that if you looked at the table, it's those funds that strip out the wild movements in our currency, which has been the result of Theresa May getting all lost around Brexit and all those various issues we have that are UK specific and affect the pound, like interest rate moves with the Bank of England. That was wrecking anything you had abroad in Japan returns. But if you hedge that out, and there are some over in Japan that do that, then you were making lots of money. So again, it's really just explaining that if you can try and ask why, then you might start realising, oh, do you know what? In Japan, there is a good reason to hedge sometimes and a good reason not to hedge. And you can therefore take that on board and start to look at that relationship between currencies and stock markets, and you might find something interesting in it. So again, look at performance tables and try and see what they're telling you, if there's an underlying story. Sometimes there isn't, but quite often there is. I mean, the reason why I obviously like momentum investing as well, which is what 80-20 Investor is based upon, is you don't always have to understand the trend, you just follow it and you can make the most of it. But it's good, and I try and teach people with 80-20 Investor what the trends are and why they are happening, because you might want to follow the momentum, but sometimes you might decide, for whatever reason, you don't want to follow that trend for a specific reason, because you have an opinion on where the pound might be going, for example. So, yeah, there you go, Andy.
Good. And this week it is a bit of a bumper episode for investors, so strap in, because we've got another investor piece coming. Damien, what else are we talking about in terms of investment this week?
Well, the last piece is that I'm often asked things like, what funds could you buy to benefit from the budget? Which funds out there would get a budget boost? And it's a very, it's a bit of a clickbait type of headline, but the newspapers are desperate to write something, especially in a budget that was as boring as the one we just had. And so they'll go and look at anything. And I've written things about like that in the past, and it's totally understandable. I mean, one thing I would say is, well, this next piece is about how you find one of those funds that will benefit from this budget. And I can understand why people might try and do that, because when they announce some of the big macro kind of investment schemes or plans they have, which won't affect you and I personally, but they might decide to do lots of infrastructure spending or house building, then there are some companies out there who are rubbing their hands together because they know there are millions, if not billions of pounds coming their way. And as an investor, you could obviously benefit from that if you invest in those companies. Now, I'm obviously not into investing in shares. You need to spend a lot of time and effort looking at their cash flow and all that kind of stuff and their accounts. Obviously, fund managers do that on all the time, and they have teams of analysts who do it. So I'm much more a fan of investing via funds, which therefore invest in lots of companies and reduce the risks that are involved in investing in any one particular company. And all you have to therefore do is pick the best funds. So, taking that idea and looking at this budget, one of the main measures that was announced were trying to boost the number of houses that are being built. And it just feels every time I watch a budget, that seems to be an underlying message that the house builders will benefit, because if you're building houses and they're throwing money at you to build more, then I'm sure it's going to just boost your profit margin along the way. So therefore, a very simple idea would be go buy house builders, invest in companies that build houses. And that's not always that easy when you look at funds. And if you go out there, there's not a fund called the House Builders Fund. There aren't that many companies out there that are doing it on a sort of large enough scale. So you sit there and think, well, how would you find one? And the one way to find them, and this is a tip that to take away from this podcast and use in the future if you want to, the way to find them is to look at the mid-cap funds. So they're funds that tend to have they normally have 250 at the end. So what I'm talking about is that house builders tend to live in the FTSE 250 index. That's where they are in terms of size. So you'll get funds that invest in that mid-cap range, and they may have the words 250 at the end because they try and sort of show people that's where they're investing. Those are the funds to go and look at. When you're online on your fund platform, go and find them. You'll get about half a dozen maybe of those type of funds, and then you go in there and look at their top 10 holdings, and you will more than likely find there will be house builder names in their top 10 holdings, and you'll get a broad feel for how much they're investing, and then you can pick the fund that will benefit from house builders. But of course, generally speaking, they won't have more than probably 20% in there anyway, probably quite a bit less than that. So you're not going to be getting rich out of house builders, but there's no guarantee that the house builders will benefit from this budget anyway. There are some people who think they may not, but there you go, horses for courses. The other one is Hammond seemed to be very keen on technology, and I think part of that reason he's trying to increase our productivity as a nation. We're very unproductive, and the tech companies out there are supposedly going to get a boost. And so again, how do you find those tech companies? Now, there are technology funds, but a lot of them tend to invest in tech companies, maybe larger ones, or some of them abroad. One way to find them is actually to look at smaller companies' funds. That's a whole sector in its own right. And look in those areas, because they tend to go down that sort of low level, and there's a number of tech startups down there. And the other one is if you look at funds that have special situations in their name. I'm not one for picking funds based on name. It's a bit like picking horses based on names. Yeah. They tend to have no relevance. But in these two examples, they actually do. Special situations seem to be a buzzword they were chucking on the end of anything. They was trying to find something that was... They didn't really know how to pencil it in, but they called it special because it did something that was slightly different. So they went for maybe tech companies. And there are one or two of these funds that actually specialise or have a very tech feel to them, and it'll be because the manager has quite a good understanding of the sector, and once he's had some luck in there and picked some good companies, he tends to have a bias. And there have been some historical... I'm not going to name funds because if people listen to the podcast in the future, it may not still be relevant. So the general advice is go to look at smaller company sectors, and therefore some of the funds you may see that have the word special situations attached to them, and then dig through on their top 10 holdings. You can find their fact sheets when you go and find the fund on your platform and click through, and they will also tell you there'll be a pie chart that tells you the sectors they're exposed to. Look for IT or telecoms or something like that in there. So there you go. I think I'm done, Andy. I think I've actually managed to keep it within 30 minutes this week. I'm quite impressed.
Yeah, absolutely, Damien. Yeah, well, listen, when it goes over 30 minutes, all that's doing is that's giving our dear listener an extra nugget, an extra piece of advice, more value. And how cheesy does that sound saying that? So anyway, let's move on. We're done. To get in touch with you, at Money to the Masses with a number 2.
Yes, Andy. I mean, I'm really am quite impressed. After 156 shows, you still say that in a slightly unsure way.
I don't say it with any conviction, do I? I say it with I'm basically putting a question mark at the end as I say it. So at Money to the Masses with a number 2. If you've got something slightly more lengthy, then or any feedback or anything that you want Damien to know that you don't necessarily want to shout about to the world, then feel free. It's podcast@moneytothemasses.com. And please, we always say this, and sorry to have to say it again, please do review the podcast. We're looking to get up to 100 5-star reviews, and we're really not far away from that. So thank you for that.
We're only a couple away, Andy, actually. So do that. And don't forget, on Twitter you can now have twice as many characters, 280 I think it is. So you can ask even longer questions. So that's it for this week, Andy.
Until next week.
Until next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.